NFTs selling for millions. How pictures became assets overnight. Imagine telling someone in 2019, one day people will pay millions of dollars for JPEG images. Not paintings, not sculptures, not rare photographs. JPEG files. Things you can right-click, save, duplicate, email, delete. Most people would laugh. And yet, that's exactly what happened. In 2021, a digital collage sold for $69 million. Cartoon monkeys sold for more than houses. Pixelated faces became status symbols. And thousands of people around the world suddenly believed they were early investors in the future of wealth. This is the story of how pictures became assets, and why almost nobody actually understood what they were buying. Let's start with a simple question. What is an NFT? NFT stands for non-fungible token. That sounds technical, so let's translate it into human language. A dollar is fungible. Any dollar is the same as any other dollar. An NFT is non-fungible. It's supposed to be unique. Think of it like a digital certificate of ownership. Not ownership of the image itself, but ownership of a token that points to the image. Already weird? Good, because this is where confusion begins. When you buy an NFT, you usually do not buy copyright, reproduction rights, exclusive control. You buy a line of code on a blockchain that says, "This wallet owns token number 47,235. That's it. The image itself usually lives somewhere else, often on a normal server, sometimes on cloud storage, sometimes on a website that can literally go offline. So what exactly are you buying? Not the picture, not the file, not the art. You're buying recognition, a socially agreed upon belief that this token represents this image, and I own the token. NFTs only work if people agree they work. Just like money, just like collectibles, just like status symbols. Which brings us to the real engine of the NFT boom. Not technology, not art, storytelling. Around 2020 and 2021, three powerful narratives collided. Crypto is the future of money. Everything is moving online. Early adopters get rich. Mix those together and you get digital ownership is the next gold rush. NFTs were marketed as digital real estate, digital fine art, digital luxury brands. People weren't buying images, they were buying identity. Owning an NFT wasn't about liking the picture, it was about signaling. I was early. I get it. I'm part of the future. That feeling is incredibly addictive. Then came the success stories. Someone buys an NFT for $200, sells it a month later for $20,000. Screenshots flood Twitter. Social media groups explode. YouTube thumbnails scream, "This NFT will 100x." Nobody talks about the thousands of NFTs that go to zero. They talk about the one that moonshots. Because humans don't learn from averages. They learn from outliers. And outliers create FOMO, fear of missing out. The most powerful force in financial history, or at least in financial bubbles. People stopped asking, "What is this worth?" They started asking, "How fast can I flip it?" That's the moment something stops being art and becomes a speculative chip. Here's where things get uncomfortable. Most NFT buyers did not understand how blockchains work, where the images were stored, what rights they had. They didn't care, because understanding slows you down. Speculation rewards speed. And when prices are going up, ignorance feels like confidence. NFT marketplaces made everything frictionless. Click, connect wallet, buy. Congratulations, You're now a collector. No galleries, no curators, no expertise, just vibes. Then celebrities arrived. Athletes, rappers, actors, influencers. When famous people buy something, it creates social proof. If they're buying it, it must be legit. What most people didn't see, many celebrities were paid to promote NFT projects. Some were given free tokens. Some owned pieces before telling their followers. But on social media, it looked organic, which is all that matters. The machine fed itself. At its peak, NFT trading volume hit tens of billions of dollars. JPEGs became collateral. People borrowed money using NFTs as assets. Let that sink in. Loans, backed by cartoon images. Not because the pictures generate cash flow, not because they produce income, but because people believed someone else would pay more later. That belief is called greater fool theory. I don't need to know what it's worth. I just need to find a bigger fool. That works, until the supply of fools runs out. And then, quietly, the floor fell out. Trading volume collapsed. Prices dropped 80%, 90%, sometimes 99%. Collections that once traded non-stop became ghost towns. Social media went silent. Influencers moved on. And a brutal truth emerged. Most NFTs were never scarce. Anyone can create infinite new collections. Scarcity only exists inside a single project. But humans don't experience scarcity that way. They experience novelty. And novelty expires. Another harsh realization. Digital ownership doesn't feel real to most people. You can't hang it on your wall. You can't wear it. You can't display it easily in everyday life. It lives inside a wallet most people never open. Contrast that with physical collectibles. Art, watches, cars, wine. They exist in the real world. NFTs exist in a browser tab. That matters more than technologists want to admit. So were NFTs a scam? Not exactly. The technology is real. Blockchains work. Tokens exist. But a technology existing does not mean every use case makes sense. Email exists. That doesn't mean spam is valuable. NFTs revealed something much more interesting than a new asset class. They revealed how humans assign value. Value is not objective. Value is social. If enough people believe something is valuable, it becomes valuable. Until they stop believing. That's true for tulips, .com stocks, meme coins, NFT JPEGs. Different packaging, same psychology. The takeaway? NFTs weren't really about art. They weren't really about technology. They were about speculation wearing a futuristic costume. And speculation always tells the same story. This time is different. It almost never is. So next time someone says, "This JPEG is worth millions," the correct follow-up question isn't, "Wow, really?" It's, "Who else believes that? And why?" Because in markets, you don't make money by owning cool things. You make money by understanding belief systems. And belief systems can change overnight. Like this, if you never want to lose money because of social frenzy, subscribe for more wild money stories, and I'll see you in the next one.